Good day. Welcome to this third session on financial management. Okay, just a recap from last week. If we look at the history of accounting and the development of accounting, we talked about how it started the first accounting about 5,000 years ago, where people needed to record what property they owned. And later, in the 1400s, a gentleman by the name of Pacioli, who introduced the T accounting, debits and credits. In Italy, he started recording how the merchants in Venice recorded the transactions. Okay, so since then there's been lots of developments and how we've moved from GARP to IFRS, International Financial Reporting Standards, that we all have to comply with nowadays. Okay, just to recap. On the double entry accounting, some important rules. Okay, let's just have a look. When we talk about assets, assets are resources that's owned by a company. They control it, and from which future benefits will flow, economic benefits. But assets, if you think about it, if you take your household, when you have a bank account where you have your money, that's an asset. You have your house, that's an asset. You buy furniture, that's an asset. Your motor car, it's an asset. So those are the assets that you have. Now, when we start, remember in double entry accounting, we have a debit for every credit and a credit for every debit. Now, the rules of accounting, and you'll see it later when we start doing T accounts, when we have assets, when we debit an asset, okay, you debit an asset, then it means that the asset will increase. Okay, when we talk about a T account, that's about what we mean by a T account. Oh, I still have to learn how to draw these things. So when we say you debit is this side, and credit is this side. So when we have an asset and you debit the asset increases, and if we credit the asset, it decreases. So for example, if money comes into my bank, I debit my bank. If I pay money out of my bank, I credit my bank. If I buy a vehicle, I will debit my vehicles account, and then my vehicles, the assets will increase. Liabilities, on the other hand, are things that we still need to pay. We owe money, we owe someone something. So that's a liability. It's a commitment that we must pay something. Now, liabilities typically, if you bought a car on lease or hire purchase, installment sale, that will be a liability. If you have a bank overdraft, that's a liability. So as opposed to assets with liability, if we debit the liability increases, and if we credit the liability increases. Okay. So it is the opposite as assets. Then we get to income and expenses. Income, if we debit the income, okay, it will mean that we decrease it, and if we credit the income, we will increase it. So if you If we then say, let's say we have an asset, there's my bank account, or an asset account. So if we now say, okay, I had sales. Okay, this is now my income. So I have cash sales. So I will credit my income account, my sales account, I will credit. So that increases. And I will debit my bank, which is an asset, and the bank increases. So that is how it works. We have an asset, a transaction on the left there, increase, and then one here on this side. Expenses on the other hand, so this is my expense again, let's say wages, salaries. I pay out of my bank, so there it goes out of my bank, and it goes from there to my expense account. So if expenses, if I go to expenses, they debit, the expenses increase, and I will credit my bank, and my bank will decrease. So that is how that one works. Then we have our capital account. Capital, that is the money or contributions that the owners of the business makes to the business. And again, if we credit our capital increases. So let's say the owner puts 10,000 Rand into the business. And let's assume this one at the bottom represents the capital account. Then he goes the money, he's putting money in there. So we credit the capital account and the money goes into my bank and I debit my bank account. Okay, so that is so the bank increases, the asset increases, and my capital on the credit side, that increases. Okay, if we debit the capital account, it reduces again. And then it depends what the counter transaction will be. Drawings, that's the money or goods that the owners of the business take out of the business. And with drawings, you will, if we debit the drawings increase. And if we credit the drawings decrease. For example, let's assume that the bottom one here represents the drawings account. So if the owner takes out 10,000 Rand from the business, I credit my bank, so my bank reduces, and I debit my drawings account, which increases. So the debit drawings, if you debit it increases, and if you credit it, it decreases. Okay, we talked about management versus financial accounting. So let's look at the terms of internal versus external reporting. Now, management accounts, that's an internal reporting. Now, management accounts, these are reports that we produce on a monthly basis. And it includes income statement, balance sheet, it includes budgets, it includes debtors ledger, creditors ledger, and cash flow forecast. So those are all management accounts. That's our internal reporting. And what do we want to do and achieve with that? With management accounts, internal reporting, we want to see how did the results compare to forecasts and budgets. When you do a budget for the month or for the year, you say you budget a certain revenue that you're going to make, certain level of sales, and certain expenses that you budget for. Now you have gone through a month, and let's say you said you're going to make 100,000 in sales. Now you've gone through the actuals for the month, and now you've made 110,000 for sales. So now you want to compare that to your budget. Okay, if you're over budget, that's fine in terms of revenue. But if you forecast that you're going to spend 5,000 on wages, and now you spend 15,000 on wages on the expense side, that means you've got a way over budget and that is a very negative effect. So that is what we do with management accounting. We want to see how what the effects are of the different things. Okay, we want to see what the sales, expenses, debtors, and creditor trends are. So we want to see, is our sales increasing over time? Is it decreasing? What is happening with that? Same with expenses. Is it increasing, decreasing? Does it remain the same? So that is what we want to try and see there. Then very important, what is the cash flow outlook? Remember, without cash, you cannot operate a business. If you don't have cash, you cannot pay your wages or salaries. You cannot pay your rent. You cannot buy stock. You can't do anything. So it's very important to make sure that you have a cash flow forecast and to see where there's going to be shortfalls, that you can plan for that and see how you can maybe get an overdraft from the bank for those periods where there's a shortfall in the cash flow. And then also you can, in your budgets that you've prepared in management accounts, you can see what capital expenditure you have planned. Okay, did you plan to buy a new truck, new equipment? So that's your capital expenditure. Okay, then we have external reporting. That is the IFRS. So that is the external, that's your annual financial statements that you have to prepare. So if we look at those, we say it's got to be relevant. Okay. Simply meaning that you must report what is relevant to your organization and to the financial performance of the organization. There's no point in reporting anything different. Okay. So you must. Okay, we say that officially and definition-wise, information is material if its omission or misstatement could influence the economic decisions of users. So if you leave something out, and that means people make a wrong decision, then it means that you have omitted, and then that information was relevant. Faithful representation. It means that it must state facts, what the situation is. You mustn't lie, you mustn't give wrong figures. We have seen this in the past. If we look at Steinhoff, what Marcus Jooste did there, he did what we call creative accounting, and he gave figures that is not faithful. In fact, he just lied. There's no other way of putting that. So the information must be faithful. Comparability. You must be able to compare your financial figures with previous year's figures. So from one year to the next year to the next year, you must report the same thing, the same standard, so that you can compare your current figures to previous year's figures. And you must also be able to compare your financial statements to other companies' financial statements. So comparability. Okay, understandability. Okay. So people that are users of your financial statement must be able to understand what you are reporting. Now, obviously, not every man in the street or woman in the street will be able to understand financial reports, but for people that are the users of financial information, they must be able to understand it. Now, using GARP and IFRS assist in the fact to make it understandable because everyone uses the same terminology, etc. Timeliness, you must report it on time. If it's too late, it doesn't help. We have seen with some of our parastatals like SAA, then suddenly for 3 years they can't submit their financial statements. And it doesn't help they submit the statement 3 years later for what happened 3 years ago, because then no one can take corrective actions. Steinhoff, the same thing happened there. The auditors didn't want to sign off their financial statements. So it means the statements were not published in time, and that caused a big chaos. Okay, verifiable. If you everything that you include in your financial statements must be verifiable. So there must be a proof of every transaction. So whether it's a source document or whatever the case may be, it must be verifiable. Yes, so that's our internal, external reporting. Okay, in terms of financial accounting, just the difference between management accounting, financial accounting. Financial accounting, we report to stakeholders outside the organization. Okay. Okay, there are some, internally it's also used by management, but financial statements are published for external users primarily. Financial accounting, we summarize past events. In other words, we take what happened in the past and we record what happened in the past. With management accounting, on the other hand, we try and project what will happen in the future. And then we have said this data must be objective and verifiable. The precision of the information must be correct. And then importantly, data is summarized for the whole organization. So if you take a company like Pick n Pay, for example, they have different, they have the normal retail stores, they have Pick n Pay clothing, they also now have Pick n Pay liquor. And if you look at these revenue figures, they will simply say that the group made, I don't know, 20 billion revenue. They're not going to break it down into the three different groups, or even further. If you take a normal, the Pick n Pay supermarket, where you have different departments, you have your meat, butchery department, you have your bakery, you have your fresh produce, fruit, vegetables. So you have all those different departments. Now in management accounts, those things will be, the detail will be provided for the different departments. But in the annual financial statements, it will not be, it will just be summarized. Okay, it must follow GARP, Generally Accepted Accounting Practices, or IFRS, International Financial Reporting Standards. And it must be in the form of financial statements. Financial statements, you have your statement of comprehensive income, your statement of financial position, statement of cash flows, and the statement of changes in equity. Okay? Those are the different documents that form part of your financial statements. Okay, we've just had a look at financial management accounting, reports to stakeholders inside the organization. Emphasis on decisions affecting the future. So we are future orientated, we're financial accounting, we were history. The data must be relevant and flexible. You must be able to change data. So if you have a budget, you can't have a fixed budget. You must be able to make changes to your budget as time goes on. Timeliness of information. So if you have a budget and you want to report progress against the budget, it doesn't help you 6 months down the line in the budget. Now you report for month 1. You must. Most companies will report monthly on actuals against budgets. Okay, detailed reports on departments, as I've mentioned, the Pick n Pay example. Okay, we follow an accounting framework, so it's not just in any form. It's not, if you do a cash budget, for example, there's no prescribed format. However, most people use a similar format, but it's not prescribed by law. But so we do our reports, etc., in an accounting framework, but not a legally prescribed framework. Okay, reporting is voluntary. So you don't have to report, but we report is simply voluntary inside the organization. So you find small companies, they won't produce financial management accounts regularly. They might do it quarterly because it's voluntary. It's not a requirement by law. We could just go back to our legal different business forms. We have covered it in the past, so let me just touch on that again. The different accounting or business entities that we have. First one is our sole proprietor. So if we talk about the legal personality of a sole proprietor is a one-man business, and the legal personality is the owner of the business. He is the legal entity. Okay, so how does he start the business? He doesn't register the business anywhere. Having said that, depending on the type of business, he might have to get a license from the local authorities, but it's not you don't register the business at the CIPC or any place like that. How does he get his capital? He provides his own money or borrows money. Ownership and management. The sole proprietor manages his own business normally. Distribution of profits. All the profits belong to the owner of the business. The tax on the profits that the company make, or the business rather, as the owner is the legal entity, the income tax is paid by the owner himself. Okay, so that is the sole proprietor. This next form of business we have is a partnership. Partnership, that's 2 or more people get together and say they want to start a business. So the legal personality, the partnership, the partners, they form the legal entity. It's not a separate legal entity. They are the legal entity. Okay, how do they start the procedure? Again, there is no requirement to register a partnership. But as I've said before, it's always wise to have a partnership agreement. How do they get their capital? They will provide their own capital, or they will borrow money. Ownership and management. The partners owns the business and they manage the business. Distribution of profits, it gets shared between the partners according to the shareholders agreement that they have. It doesn't necessarily mean it's a 50-50 share. It could be a 60-40 share or whatever the case might be. Income tax, the partners will pay income tax in their own personal capacity according to the share of the profit that they've taken from the partnership. Okay, then we have the closed corporation, a CC. It's one that we still have them, but you cannot register a new one. So the legal personality, a closed corporation, the CC is a legal entity on its own. Okay, so it can sue and can be sued. It's a legal entity on its own. Starting procedure, Previously, it was registered. You had to register it at the CIPC. Obtaining capital. The members, the CC doesn't have shareholders, they have members. The members will provide their own capital, or they will borrow money. So they will make members' contributions to the CC. Ownership and management, the members owns the CC, and they can manage it, or they can get managers to manage it on their behalf. Distribution of profits shared by the members. And income tax, the income tax on the profits is paid by the closed corporation. Then we have companies, and we have a private company and a public company. So in both cases, the legal personalities is the company. The company legal entity can sue and can be sued. Starting procedures, they are registered, private company and public company registered CIPC, and the public company is then also listed on a stock exchange. We have 4 different stock exchanges in South Africa now. The Johannesburg Stock Exchange is the most well-known one, but there are also some other online stock exchanges. How do they get their capital? A private company will issue shares and raise their money through issuing of shares, but not to the general public. It is to certain individuals who will buy shares or invest in the shares, and they can borrow money. Ownership and management. The shareholders owns the business. Normally they will appoint managers or a board of directors to manage the business on their behalf. Distribution of profits. Profits is paid out in the form of dividends to the shareholders. And the income tax, companies pay tax in their own capacity. Company tax rate at the moment is 27%. It's the company tax rate. Okay. Okay, if we then look at the accounting cycle, so we've now talked about different forms of internal reporting, external reporting, etc., etc. But now let's look at what we call the accounting cycle. What is the process we're going to follow? Because we want to publish financial statements. So how does this whole thing start? Okay, first it starts when a transaction takes place. Okay. What do we mean by that? You buy something or you sell something, and that's a transaction. So a transaction takes place. Then you have source documents summarize the transaction. So the typical transactions that take place, you buy something, you sell something. Or you have general operating expenses, as it's called. You pay salaries, you pay electricity, etc. Okay, so if you, for a normal sale to a customer or you buy from a supplier, you will have a source document. You will get when you sell, you issue a customer invoice. When you purchase, you'll get a supplier invoice. Okay, and those are called source documents, and they summarize the transactions. Now, each of these transactions, we then do a journal to summarize the source document. So if what a journal is, you say which account must be debited with what amount, which account must be credited with what amount. Pardon. So that is the journals that we do. And then somewhere in between, as I say, we do what is called a bank reconciliation. Bank reconciliation simply means you take your bank statement and you make sure that all the transactions in your bank statement has been recorded in your accounts, and that your cash book The cash book is the term we use for your bank account in your business, so that your cash book balance must balance with the bank account balance. So that is the bank reconciliation. Then we record all these journals in what we call the general ledger. The general ledger will include all your different income, expense, asset and liability accounts. Is in your general ledger, and all the transactions get recorded in your general ledger. Then at the end of a period, this could be on a monthly basis, we then do a trial balance. What we mean by trial balance is you have in your general ledger, you have all the different accounts. You could have, depending on the size of the business, in between 20 and 100 different accounts. Now remember, for every debit there must be a credit. So your trial balance, you will list all your accounts with their respective balances. Some will have debit, some will have credit balances. And then you add all the debit balances together and all the credit balances together. And those two amounts must balance, they must be the same. That means you have, in terms of debits and credits, you have recorded correctly. Okay, so that is your trial balance. Okay, now at the end of the financial year, and there's something that is missing in the textbook, because when you get to the end of the financial year, we still do what is called year-end adjustments, because there are some transactions that we have to record, which is not in the form of a source document, for example. You get things that are called prepaid expenses that you've incurred this year, but it actually belongs to the next year. You can get income received in advance. People paid you in this year for something they'll only get next year. So there are those adjustments. So after you've done your trial balance, you do your year-end adjustments, and included in that is also depreciation and other adjustments that you may make. And then once you've done that, you will do another trial balance to make sure that everything balances. Okay, and once everything balances on your trial balance, then from there you produce your statement of profit or loss and other comprehensive income that summarize your financial performance. That's your old name is income statement, and you produce your statement of financial position, which is your balance sheet. So that is what we will produce at the end. Okay, what is source document? You can have a look in your textbook. Okay, let's have a look at the different type of transactions that we find in a business. And we will be doing the different, you have to know for each of these transactions, which account get debited, which account get credited. But we will still get to that, but we'll just go through the different type of transactions. Okay, the first one will be your owner's contribution. So whether it is share capital, whether it's additional capital, but the owner contributes something to the business. It can be in the form of money. The owner can also, for example, give a building, which is, let's say he owns a building, so he puts the building in the name of the company. So that goes through as owner's contribution. Owner's withdrawals, also referred to as drawings. That is when the owner takes money or goods or assets from the company for his personal use. Owners are allowed to do that, but you have to record it. And some of these withdrawals will also attract VAT, which is something, and small companies, owners ignore the fact that they have to pay VAT on some of these transactions. But they can take money out, they can take stock out, so that would be owners' withdrawals. Okay, then the third type of transaction that we have receipts from customers, which is cash sales. So there'll be a sale, it's cash, and the customers pay cash. Okay. So there's a particular way that we enter that. Then we do invoices to customers. That is, if we sell on credit to a customer, we issue an invoice to the customer for the sale. And there's a particular way that we record that. Now, once we've sold to a customer on credit and invoiced him, the customers eventually must pay for the goods that he purchased. So we will have receipts from customers for credit sales. Okay. Then we have payments. On the other hand, we pay cash for suppliers for cash purchases. If it's a credit purchase, we will receive an invoice from the supplier for a credit purchase. They've given us 30 days to pay. We get the invoice, and there's a certain way that we record that in our books. Then we do payments to suppliers for credit purchase. So once we've done the purchase, we've got 30 days to pay, and in 30 days' time, we're going to pay. And there's a payment to supplier for credit purchases. Then we have customer returns. Okay, we've sold something to a customer, they're not happy with the product, so they will return it to us. So that's a customer returns. And then returns to suppliers. On the other hand, we have purchased stock or something from a supplier and we want to return it. So that's return to suppliers. Then we have other. That's other expenses. That's the typical operating expenses. Your wages that you pay, your electricity that you pay, your rent, your telephone, your entertainment, all those other expenses. Okay, so those are the typical transactions that we will be looking at in the future, that you must know how to record these transactions. Okay, so let's quickly look at the record keeping, a journal. Okay. As I've said, the journal is it's a particular layout for that, and in the journal you put the date of the transaction, you describe the transaction, and you say which account must be debited and what amount, and which account must be credited and what amount. So that is the journal. Bank reconciliation. As I've explained, you have your bank statement, and you must make sure that all the transactions on your bank statement is recorded in your cash book. Now, when we talk about source documents for transactions, on your bank statement, your bank fees and bank charges that they charge you, they don't issue you an invoice for that. It appears on your bank statement. So those are transactions that you still must capture in your cash book. They don't appear automatically in your cash book, but all your cash and all your transactions that went through your bank must be in your cash book. Okay, we have computerized accounting nowadays. Okay, there we do a general ledger, a trial balance, and a statement of profit and loss, a statement of financial accounting. Life is much easier nowadays with different packages. I have a small business that I do books for companies. I use Pastel Accounting or Sage Accounting, and it makes it very simple and very easy to do all the different accounts. Okay, then that is about the end of this chapter in the textbook. So I suggest you go through the activities that's in the textbook for chapter 2. Make sure that you understand any queries that you have. You can just email me with queries, or you can log in next time, and then we can address the queries that you have. Okay, so next session we will be more on practical accounting. So we look at how we record the transactions and what we must consider when applying the double entry system. Okay, that is the end of this session. Thank you and goodbye.